This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Holiday cheer. Shoppers hit the spend button, sending holiday sales higher by the most in 6 years. The big winners and what investors need to know about what's going on in retail. Falling Apple. Shares have their worst day since August on a report that demand for its iPhone 10 might not be up to expectations. And 3 for 18, a trio of stock picks that our guest says need to be on your shopping list for 2018. All those stories and more tonight on Nightly Business Report for Tuesday, December the 26th. Good evening, everybody. Welcome to the program. I'm Bill Griffith here at the New York Stock Exchange. Tyler and Sue have the evening off, and it seems that many people this holiday season made their lists and checked them twice, or by the looks of things, maybe even 3 or 4 times. What I mean is we were in a buying mood as shoppers came out in droves this year, driving holiday retail sales by some estimates to their biggest increase since 2011. And that naturally sent the retail sector higher on Wall Street today. And as Kate Rogers tells us now, it might not yet be over. She's in West Nyack, New York for us tonight at where else? A mall.
Christmas may be over, but retailers have a lot to celebrate. The latest numbers from MasterCard point to the best holiday season in more than 5 years. Retail sales rose by almost 5% from November through Christmas Eve. Online sales are up even higher, 18%. Overall, sales are projected to reach $682 billion.
I got an Apple Watch and a hockey stick.
A laptop and Universal. I'm going there in January.
My top gifts, time with the family, my son.
Shoppers aren't slowing down anytime soon. In fact, they're set to spend some $69 billion in the week between Christmas and New Year's. ShopperTrack projects today, December 26, as the 4th busiest shopping day of the season. Shoppers we spoke to were eager to take advantage of the deals.
Macy's had like a 40 to 60% off, so I got a great deal on, Calvin Klein coats. So I really lucked out today.
Maybe Foot Locker, maybe check out Vans.
To get good prices, it's like 50 to 75% off after Christmas, and then you can save it for next year.
Because Christmas fell on a Monday this year, shoppers got an extra Saturday. This weekend's, dubbed Super Saturday, was set to be the second biggest day of the season in terms of in-store traffic, with people coming in for the last-minute rush. And while the holiday shopping season may be coming to a close, it's just the beginning for returns. An estimated 10 million people are set to return or exchange gifts. And other shoppers, they're just around for the ride.
They didn't bring money.
For Nightly Business Report, I'm Kate Rogers in West Nyack, New York.
And many of those sales were delivered right to people's doorsteps, and as is always the case, there were a lot of them. And those extra packages created extra logistical challenges for the delivery companies like FedEx and UPS. So how do the big boys do this year? Morgan Brennan has our report card tonight.
We won't have the full picture until earnings, but early readings suggest UPS and FedEx pulled off a record peak season. Well, despite warning on Saturday that wind shear had caused disruptions at its main express hub in Memphis, FedEx managed to deliver 98% of its express packages on time for the week ended December 23rd. According to third-party tracker ShipMatrix, adding Christmas Eve, since some deliveries did go out on the 24th, and FedEx delivered 99.9% of its packages on time. It was a similar performance for UPS. After sorting a record number of shipments at its main air hub in Louisville, 96% of its express packages got there on time, including Christmas Eve, over 99%.
3 things that help packages get delivered on time this season were: 1, big investments by everybody in the industry in better service, better equipment; 2, no bad weather; and 3, customer expectations. People in the last couple of weeks spent more time going to brick and mortar and less time online.
But getting there wasn't easy. UPS repurposed several hundred office staff to help sort and deliver packages this holiday season. The company has assembled these so-called ready teams in the past, but this year did so with less lead time, as volumes turned out to be higher than expected in some markets. Drivers worked extended hours as well. Record volumes, strong service, but executed in the midst of a tight labor market. UPS and FedEx were looking to hire a combined 145,000 seasonal workers, but it was tough finding folks.
We're going to see more automation. We're going to see more robotics. It's going to happen. It's coming, like it or not, because you can't find people to do the job.
But the peak shipping season isn't over yet. Now returns start. And as online shopping continues to soar, so too do the packages headed back to retailers. UPS expects the busiest day for returns will be January 3rd. For Nightly Business Report, I'm Morgan Brennan.
And it's no surprise that Amazon was one of the big drivers of those package deliveries. Company says by some measures, this was its best holiday season yet. Amazon said that more than 1 billion items were ordered during the period, and that in 1 week alone, more than 4 million people either became members of their Prime service or started a free trial. Overall, Amazon is expected to grab more than half of new holiday sales this year online. Shares are up a fraction today. And looking ahead, what does the new year have in store for this online retail giant? Our Deirdre Bosa takes a swing for us tonight.
2017 was a big year for Amazon. Its stock crossed $1,000. It splashed into brick and mortar with its purchase of Whole Foods. Jeff Bezos became the world's richest man. And Alexa? Well, Alexa became a household name. So what's in store for 2018? Here are 3 predictions. First, as Amazon sells more smart speakers, consumers will do more than ever with just their voice, from shopping online to controlling the home. But it will be a high-stakes battle between tech titans as they battle to get their devices into your home, so expect more third-party developers for Alexa and a bigger skills catalog. Second, we'll find out if 2018 is the year consumers finally embrace online grocery shopping. This as Amazon continues to lower prices and integrate Prime membership into Whole Foods. Other grocers you can bet are watching closely, and they're already boosting their delivery capabilities. Third, next year Amazon will select its second home, known as HQ2. While the company's Seattle hiring boom is cooling off, you can expect a new growth spurt in a new city. For Nightly Business Report, I'm Deirdre Bosa in San Francisco.
Okay, so it was the strongest holiday shopping season since 2011, but maybe not for everybody. Let's talk about who might emerge as the winners and losers this year. Joining us tonight, Sucharita Kodali, who's retail analyst at Forrester Research. Good to see you again. Thanks for joining us.
Thanks, Bill.
You know, right out of the Black Friday weekend, we kept hearing how strong sales were this year. Why this year? What was going on?
Well, I think that there are a handful of macroeconomic factors. You have low unemployment, which naturally enables consumers to have more disposable income for shopping, in addition to just generally high consumer confidence. So those are really, really big factors. And then you had the earlier alluded to Monday Christmas, which allows that extra weekend for last minute shopping. So all of those factors together make for great shopping numbers ultimately for the retailers.
18% gain for online. Of course, those sales will be smaller than the brick and mortar, so you know the law of big numbers, they aren't that big yet, but still a stellar increase this year. Who are the winners in that category besides Amazon?
Well, you have a handful of pure plays. Pure plays are the online-only retailers. Companies like Etsy will be doing well. eBay has had a great Q4 over the last couple of years. They've had some great management decisions and a lot of good promotions for customers. You have companies like Houzz, which is an emerging player in the home space. So these are some of the big players that we see doing really well. And then you also have a lot of really small, lesser-known pure plays that are likely to be doing well. And also companies like Warby Parker or Bonobos, which have been getting a lot of traction with consumers in recent years as well.
And then you have those that blend the brick and mortar with e-commerce, which I think you would agree is the business model for the future. Walmart is one that stands out. Who else did you see that did well this year?
Well, you have a lot of the small format stores actually doing really well. Companies like Five Below, which are experiencing double-digit year-over-year growth and just started to really invest in their .com presence. You have the Dollar Channel actually doing really, really well these days, and they're pretty good about really merchandising their stores with seasonal assortment. Off-price retailers like TJ Maxx and Ross, they're doing particularly well. So you have a lot of retailers with strong year-over-year growth, as well as the stalwarts of retail like Costco and Walmart, naturally.
And then the losers. I mean, I keep hearing this is a make or break year for some of the retailers. The Sears, the Toys R Us, you know, some companies like that have been struggling so much. What's your outlook there?
Well, I think that the issue with some of those retailers is that they are particularly challenged. Their stores are not in great locations. JCPenney is on that list too. So we'll see if Q4 gives them any boost and any bit of a lifeline for the future.
All right, Sucharita, thank you so much for joining us. Sucharita Kodali from Forrester Research. Happy New Year.
Thank you. You too, Bill.
Elsewhere, Apple was one of the headwinds that the market faced today. It was the biggest loser on the Dow and one of the biggest on the NASDAQ. Why? Well, it stems from an article out of Taiwan's Economic Daily, which said that Apple is going to cut its first quarter sales forecast for the new iPhone X by 40%. And that possible lack of demand helped bring down Apple's suppliers as well. Our Josh Lipton has more for us tonight.
This is iPhone X. It is the biggest leap forward since the original iPhone.
Apple investors are counting on Apple's iPhone X being a big hit. Their bet is that consumers all over the world are going to upgrade to this new device. That optimism is what has helped drive a nearly 50% surge in Apple stock this year. Apple calls the X the future of the smartphone, with its edge-to-edge display, facial recognition technology, and price tag of $999. But new reports are throwing cold water on that bet. Apple stock was down today on media reports, citing Taiwan's Economic Daily, that Apple in the first quarter is going to cut its sales forecast for the iPhone X to just 30 million units. That is down from what it said was an initial plan of 50 million units. Apple suppliers came under pressure too, as investors worried about demand for this new flagship phone. Qorvo, Cirrus Logic, Skyworks, and Finisar all moved lower. Analysts are weighing in too. Consumer Intelligence Research Partners notes that the iPhone X accounted for just 30% of iPhone sales in the month after its launch on November 3rd. The less expensive iPhone 8 and 8 Plus, in contrast, accounted for 39% of sales.
But it clearly did not, quite meet the hype and the expectations, at least based on percent of share or market share of the total phone. So we were, I suppose, a little disappointed at that point as well.
Not everybody is so downbeat. Gene Munster of Loop Ventures says his checks indicate strong demand for the X, that adoption of this smartphone is in fact greater, not less, than what Wall Street expects. Others point to China as a potentially surprising bright spot.
Early indication of the second largest market for iPhone is that it's doing surprisingly well in the first weeks of sales. So there could be some upside surprises to iPhone X, but overall the sentiment is down.
Apple declined comment on these reports. Investors should have a better sense of just how the iPhone X is really performing when the company next reports financial results early next year. For Nightly Business Report, I'm Josh Lipton, San Francisco.
And that 2.5% decline in Apple, that was the biggest decline they've seen since August, and it hit the entire market, especially the Dow, where Apple accounted for a loss of 31 points on the index. Otherwise, the Dow would have been higher today. It was down just 7 when it closed at 24,746. The NASDAQ fell by 23. The S&P 500 was off by nearly 3 points. But oil prices jumped to 2.5-year highs today, helped by news of an explosion on a Libyan pipeline. Domestic crude oil closed at $59.97, its highest level since June of 2015. The price per barrel briefly did touch $60 a barrel early in the day, also for the first time since June of 15. So with oil sitting at those 2.5-year highs at that critical level of $60 a barrel, what should we expect when the calendar hits 2018? Jackie DeAngelis looks for answers.
2017 was a volatile year for oil, with barrels from $40 to around $60. Crude traded a broad range. The fluctuations in price didn't just impact the futures market, they impacted stocks as well. The S&P energy sector underperforming the broader market. Here's what to expect in 2018. Crude trades a range. Oil prices move because of supply and demand. As a result of the U.S. shale boom, the market is still oversupplied. OPEC and Russia have made an effort to correct the imbalance, but it may not be enough. And as long as crude bounces around, energy stocks will too. U.S. shale will pump. The name of the game is rebalance, but that's difficult to achieve when all the players aren't cooperating. In 2017, U.S. shale producers pumped at record levels. It's likely that trend will continue in 2018, especially if OPEC supports the market. OPEC cuts will be unsustainable. OPEC producers extended their production cut agreement through the end of 2018, but many of the countries will have a difficult time adhering to these cuts as they rely on oil revenue for survival. For Nightly Business Report, I'm Jackie DeAngelis.
Coming up, now that we have that new tax bill in time for Christmas, all the special stocking stuffers in it are starting to be unwrapped. We'll take a look at some of them coming up. For all of the hand-wringing over whether the housing market has peaked or not, home prices are still rising. The widely watched S&P CoreLogic Case-Shiller Index of national home prices in October rose by 6.2% year over year. That was double the pace of wage growth and more than 3 times the current inflation rate. Strong demand and a shrinking supply of homes on the market helped push those prices higher. Of the 20 metro areas covered by the index, Seattle led the way with a nearly 13% gain, followed by Las Vegas and San Diego. The nation's capital showed the smallest gain at 3%. Well, the tax bill was signed and hung by the chimney with care, and in it were some stocking stuffers, better known as special carve-outs for some businesses. Ylan Mui takes a look at some of them for us tonight.
We've combed through the tax code, checked it twice, and now we found out who's been naughty and nice. The beer industry is making the cut. Tucked inside the legislation is a provision that lowers federal excise taxes on brewers for 2 years. For small brewers, the tax gets cut in half. For the others, the tax is reduced by about 10%, and the industry has been lobbying for this for a decade. It's had bipartisan support in the past, but it was Ohio Senator Rob Portman who delivered this gift for Christmas. And it's not just beer. Broadway also gets a tax break. Live theatrical productions, they get to take advantage of full and immediate expensing for the cost of their show. Now, it's a tax break that actually was passed under President Obama, and it's championed by a Democrat, New York Senator Chuck Schumer. But it expired at the start of this year, and the new law puts it back in. Moving on down south, Santa also made a stop at Florida's citrus farms. They get a carve-out for writing off the cost of replacing damaged plants. That is particularly important after the hurricanes this year. Growers are upset that they still haven't gotten the full disaster relief package yet, so this could help tide them over. Florida Congressman Vern Buchanan worked on that gift. He also happens to be a member of the Tax Writing Committee in the House. But perhaps the biggest present goes to the accountants. They now get to spend 2018 unwrapping all of those tax reform stocking stuffers. For Nightly Business Report, I'm Ylan Mui in Washington.
Mallinckrodt inks a billion-dollar drug deal, and that's where we begin tonight's market focus. Mallinckrodt said that it's going to buy Socampo Pharmaceuticals. It's about $1 billion deal, adding experimental rare disease treatments to its portfolio. The deal comes at a time when Mallinckrodt is looking to reduce its dependency on its top drug, which has experienced declining sales. Mallinckrodt shares were fractionally higher on the day at $23.48. Meanwhile, shares of Socampo climbed nearly 6% to $18 even. Brookfield Property Partners is reportedly reworking its offer for mall owners GGP after GGP turned down an earlier proposal. Last month, Brookfield offered nearly $15 billion for the shares of GGP that it doesn't already own. Wall Street Journal says that the private equity firm is now considering either creating a new form of stock offering or by increasing its cash bid while still offering some stock. Shares of Brookfield Property Partners rose fractionally to $21.69. GGP shares were up 8 cents to $23.48. Samsung may dethrone Intel as the world's largest chip maker. A Japanese newspaper is saying that Samsung is expected now to outpace Intel in chip sales, potentially ending Intel's 25-year streak. Intel shares lost 1% today, closed at $46.08. And aerospace parts distributor KLX may sell itself for one of its units. The company said that it is exploring strategic alternatives after it received inquiries from interested parties. KLX said that it has yet to set a timetable for that review. Shares of KLX popped about 10% on that news at $69.28. And get this, Garmin has launched its new fitness tracker, vívofit 4, and says that it can hold a charge for more than a year. The fitness and GPS device maker said that the $80 product has an always-on color display and syncs up with your smartphone. And the company said the enhancements were designed so that the user can set it and forget it, literally almost. Garmin shares up a tick to $59.27 today. Finally, Tesla CEO Elon Musk said today that the automaker will begin building its first electric pickup truck after it begins production of the Model Y SUV that's either in 2019 or 2020. Musk tweeted that he has been dying to build that truck and has envisioned its design for many years. Perhaps investors were hoping for an earlier timeline, though. Shares of Tesla finished down more than 2% today to $317.29. Coming up, a special week of Market Monitor picks for the new year. We'll get things started with a trio that our guest says will pay dividends for your portfolio in 2018. Here's a look at what to watch tomorrow. We get a fresh read on where consumer confidence stood this month, and housing will once again be in focus with the release of pending home sales and the latest data on how many potential home buyers applied for a mortgage. That's what we watch for on the final Wednesday of 2017. Finally tonight, we have our Market Monitor segment. It's the first of several stock-picking segments that we'll be bringing to you during this abbreviated holiday week. And tonight's Market Monitor has 3 dividend-paying stocks that he says have strong fundamentals and attractive valuations. Now, the last time he was with us was December of 2016, and at that time he picked Cypress Semiconductor, which is up 33% since then, Cigna, which is up 49%, and Sherwin-Williams up 52%. Don Wardell is back with us, Managing Director and Portfolio Manager at Saradex Value Advisors. Don, good to see you again. Welcome back.
Thanks for having me, Bill.
Those were such great performers. Do you stay with those? Do you sell them now? What are you doing with those 3?
Right. Well, we still own Cypress Semiconductor and still think there's a quite a runway of growth there. Whether it, just because of all the products that their analog semiconductors are in, and they have a big move in margins coming. We think they can end the year with margins much higher than where they are next year. I'm talking about with margins much higher. So we think we'd stick with Cypress. I'm a mid-cap manager, and so it's a great reason to sell. It's my favorite reason to sell, which is when stocks like Sherwin-Williams and Cigna get up into the $40 billion range. I turn that over to the large cap folks and let them have it. But I think that Cigna and Sherwin-Williams are 2 fantastic companies, and would not be afraid of owning those stocks in this environment.
They just outgrew your portfolio. Got it. All right, let's look at 3 stocks you like now. Do you like them because of their dividends? Let's go through each of them here. First one is Zimmer Biomet. Tell us about it.
Sure. So Zimmer Biomet's a medical products company, and we like the characteristics of dividend-paying stocks. We're not yield investors. We just like the dividends and what they provide us. More than just yield. And so when you look at Zimmer Biomet, the dividend yield is not, exceedingly great or anything, but it's just, again, it's something we like to see in all of our companies' capital allocations. Zimmer, the catalyst here is the new CEO. They brought a new CEO in from Medtronic. The stock's got a big margin difference from its competitors, as well as they've had some execution issues on getting new products to market. And we think that if they can execute over the next 12 to 18 months, the valuation gap and margin gap closure will drive the stock price much above where it's trading at right now. So we really like Zimmer.
Okay. Very good. Let's quickly get these other two in here. Here's an infrastructure play. And I keep hearing infrastructure may be big next year. You're picking Martin Marietta Materials.
Sure. So Martin Marietta Materials is great. Again, this is a company that's going to benefit from the rebuild in Texas, the rebuild in the Southeast from all the natural disasters. And then you also have just the state highway funding bills are going to provide a long runway of growth for them. They have pricing power. Rocks and aggregates, you can't make them in China and you can't sell them on Amazon. So this is a great business model, great company. And then if we do get a federal infrastructure bill, it's going to be icing on the cake for this company.
And finally, a familiar banking name, First Republic.
Yeah, no, First Republic's great. They're out with a growth strategy that I really like. They're going out and trying to grow their new customers by refinancing their student loans at very attractive rates. They're being very particular about the industries that they're doing that for. So then the hopes of 5-10 years down the road, there'll be wealth management, there'll be home loans, there'll be other loans that these people will have that relationship with First Republic and use them for. So we really like this company. Great management team, good company, and think they're going to do very well over the next 12 to 18 months.
Very good. Great stuff. Don Wardell from Saradex Value Advisors. Thanks for joining us, Don.
Thank you.
And that is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching, everybody. We'll see you tomorrow.